Gary Shilling has made a career out of being a contrarian. Back in January, he called for euro parity. He was among the first when the euro was trading at $1.43, and for quite a while he was right, or it looked like he was going to be right. However, the euro has turned around, rallying more than 8% since its lowest point in June. Gary's with us right now, and we're going to get into this right away. Gary, the market has turned against you. Do you still have the same conviction about euro parity that you did the last time we talked about it?
I do, Eric. I think this is the calm between two storms, and we're having a lot of storms. But right now, there isn't much going on in Europe. There's the wait to see how things work out. Some of the various countries, Spain, Greece, etc., have issued bonds. They've gone reasonably well. And, of course, people are now focusing on the U.S. and the weakness that we're seeing in the second half, possible double-dip recession. So it's kind of a shifting of emphasis, but I don't think the European problems have gone away by a long shot.
Well, let's talk about them in more detail. What makes you so certain that the problems in Europe are either going to deepen or become more apparent? And what is going to be the catalyst for the market to once again come around to the idea that Europe is beset by these troubles, and as a result, the euro will weaken?
Well, one thing in terms of catalyst is the stress test for the European banks, which are coming up at the end of this week, and they may have some unpleasant revelations. But the basic problem there is that in the Club Med South versus the Teutonic North, you have all these countries, Greece, Portugal, Spain, throw in Ireland, Italy to a certain extent, at least the southern part of Italy, which have a very non-competitive approach to their economies. You know, in Greece, you could retire at age 55. And Spain, bullfighters can retire early because they've got a hazardous occupation. You got a lot of nonsense there that is simply not competitive in today's world. And, of course, you've got a lot of financial institutions in Europe which are intertwined. I mean, the French own banks own $75 billion of Greek debt, public and private, and the Germans $45 billion.
Gary, one of the toughest things to do in the FX market is to time things right. But right now, people who are short the euro are feeling the pain. How long do you think it's going to be before we see the euro turn around? And is it possible that we'll see a new low set this year, something weaker than $1.19?
Well, I think so. Now, in our portfolios that we manage, I've cut way down on that. I mean, markets go against you. You don't just stand there in front of the freight train. But I still have a very small position short in the euro because I think this could turn around any time.
All right, there are two things you are certain about, the dollar being one, especially versus the euro, and treasuries. Look at what's going on in the treasury market. The 2-year yield down into the 50s and the 10-year at 392 this morning. How much longer can this treasury rally continue?
Well, let me say there's no such thing as in this world of certainty except, you know, death and taxes, as Ben Franklin said. But I do expect that we're going to see, I like the 30-year bond. That's been my favorite for 29 years. And that's now broken through 4% yield. I think it's going to 3%. And 10-year probably could get closer to 2%. And the short end of the curve. Short end of the curve is probably
going. Hang on, Gary. We're going to come back to the short end of the curve because I'm just still weighing the implications of a 3% on the 30-year Treasury bond.